Everyday families are bleeding cash. Consumer confidence has cratered to a brutal 4-year low. We're dealing with mutating inflation at the grocery store, massive geopolitical conflicts threatening global supply chains, and a Federal Reserve intent on keeping interest rates punishingly high. According to every traditional economic textbook ever written, high inflation combined with soaring bond yields and global instability equals a devastating stock market crash. The system is supposed to correct itself. Instead, the S&P 500 completely ignored the pressure. It decoupled from the actual economy, weaponized the chaos, and shot into a new peak, sending the Dow past 50,000. This creates a terrifying psychological trap. While the masses are sitting on the sidelines holding cash and bracing for an inevitable collapse, institutional wealth is scaling new peaks at light speed. You probably feel this tension yourself. You open your brokerage app, see these massive new record numbers, and instead of excitement, you feel anxiety. You stay frozen, waiting for the proverbial other shoe to drop before you invest. Wall Street isn't frozen. The smart money isn't panic selling their portfolios. They are quietly executing a ruthless, calculated capital rotation, moving billions of dollars into highly specific sectors, while retail investors sit paralyzed. So what exactly are we watching? Is this the final euphoric stage of a bubble right before something breaks? Or are everyday investors about to get crushed simply by missing out on the run? When market prices disconnect from consumer reality, you are effectively paying an invisible tax, losing wealth because you don't understand the machinery moving the money. To understand why prices are defying gravity, we have to look at how institutions think. The stock market is not a mirror of today's struggling economy. It is a predictive machine. It measures the future, entirely bypassing today's chaos to price in tomorrow's stabilization. Watch how this plays out on the institutional level. When terrible news hits, retail traders often short the market, betting it will fall. But the second there is even a 1% probability of stabilization, like a positive headline on inflation, smart money front-runs it. They buy aggressively. That sudden surge shatters those short positions, triggering a massive squeeze that forces the market even higher. Psychology is only the fuel. The engine driving this rally is fundamental reality. Over 80% of S&P 500 companies are actually crushing their profit estimates in recent quarters. Here is the cruel irony for the average consumer. Corporations have successfully passed their own inflation costs directly down to you at the checkout counter. Your financial pain is quite literally translated into record-breaking corporate balance sheets. And those massive corporate profits are being deployed immediately. Tech giants are funneling a staggering $670 billion into artificial intelligence infrastructure. They are building data centers, buying chips, and expanding energy capacity in a high-margin tech boom largely immune to the Federal Reserve's interest rates. Wall Street is entirely ignoring the cratering consumer metrics because they are hyper-focused on this unstoppable, high-margin technological expansion. But strong earnings don't explain the absolute refusal of the market to dip. For that, we have to examine the hidden structural forces keeping asset prices artificially elevated. This flowchart illustrates the first major force, passive investing. Every single month, millions of workers automatically contribute to their 401ks and retirement accounts. That creates a relentless, automated pipeline of billions of dollars pumping directly into index funds, completely blind to whether those stocks are cheap or expensive. Add a second, even stronger force to that exact same system, corporate buybacks. Companies are spending billions repurchasing their own shares. By extracting those shares from the open market, they reduce the total supply, artificially inflating the value of the stock that remains. Retail investors spend their time debating whether a stock's valuation is too high based on logic. Institutions know that logic takes a back seat to liquidity. Liquidity can push markets higher for far longer than anyone rationally expects, but it also creates a fragile floor. It holds everything up perfectly, right until a sudden shift in sentiment violently reverses the flow of that money. This puts you in a brutal emotional bind. You face the fear of missing out on another 50% climb, battling against the terror of watching years of your savings vanish in a sudden correction. Surviving this requires a shift in perspective. First, trade momentum, not macro headlines. Stop trying to predict global geopolitics. Instead, look for high-momentum stocks that are backed by explosive, verifiable earnings growth. Follow the institutional footprints, not the evening news. Second, implement strict execution targets. Do not hold out for a miraculous 100% gain while the global economy remains fragile. Use the 10% rule. Target realistic, high-probability compounding milestones. Lock in those profits and move your capital efficiently. Third, rely on hard trailing stops. A trailing stop is an automated sell order that locks in your profit if a stock drops by a specific percentage. It lets your winning trades keep running upward, but guarantees your exit door is wide open the second a geopolitical shock hits the tape. Adopting these habits is mandatory. Sitting entirely in cash isn't a safe harbor. It is a guaranteed mathematical loss as inflation relentlessly eats away at your purchasing power. Look at the data and you'll find what most advisors are afraid to say. The underlying economy and the stock market have finalized their divorce. The modern financial system is no longer constructed to protect the everyday consumer. It is built entirely to optimize and elevate asset prices for those who own them. You have a choice to make. You can view the world through the lens of a fearful consumer, paralyzed by inflation and economic anxiety. Or you can look at the world strategically and position yourself as an asset owner. The next record high is already being priced in. Stop being a victim of market psychology. Hit subscribe to Streets for the unfiltered truth, decode the institutional mechanics, and start building undeniable financial freedom before the next rally leaves you behind.